This is a burning question for many real estate investors. Where do I create the LLC that's going to hold my rental real estate? Well, it's easier than you think. Always create it in the state where the property is located. That is the general rule that we follow. You want to have the LLC created there because engaging in rental real estate is considered to be doing business in the state where that property is located. I can think of an individual who owns property in Florida. They were set up with a Wyoming limited liability company to own their Florida property. Now, everything worked fine. They had the property owned in this LLC. It was owned with a Wyoming LLC, and there was no issues with collecting the rents. All the monies were sent to them, except when it came to an eviction. It was time that they had to evict a tenant that had not been paying. And so they brought an unlawful detainer action in court in Florida. Well, the tenant successfully defended and had the unlawful detainer action set aside when they argued that this individual's LLC was not registered to do business in Florida, therefore it couldn't maintain an action. You see, this individual didn't realize that in order to own that rental real estate and then transact business with it from a state-specific legal standpoint, they had to be registered there. Most notably is that this individual worked with an internet company that sets up Wyoming or Nevada LLCs, and those are salesmen who are not concerned about your well-being. And they just gave them advice that is going to line their own salesman's pocket by putting them in a structure that is not relevant for what it is they're attempting to do. So when it comes to structuring, what we're looking to do is put the property, or set up the LLC that is, in the state where the property is located. So case in point, let's assume that you have property that is located in Oregon. This is my Oregon house. Then I would form an Oregon limited liability company to own this property. And it would be held in there because that's where the property is located. Now you're going to be down here as possibly as the member of this LLC, and you may set it up where you're the manager of the LLC as well. But the point is that this LLC is set up in that state. Now, one thing you'll notice here is that in using this particular structure, you do not have any anonymity. Now, a lot of times people fall into this trap. They think, I know what I want to do. I want to take advantage of Nevada or Wyoming because those two states offer anonymity protection, meaning you can use a nominee manager. And how that works is that when you create the LLC here, you set it up as a manager managed LLC, and you use a nominee manager. So many times in our firm, we use a guy named A.T. Mathis. So A.T. Mathis is listed as your initial manager for filing purposes only. And then after it's filed, he resigns and you become the undisclosed manager of your LLC. You're always the member. So if anybody looks at the Secretary of State's website, who they're going to see is A.T. Mathis. They'll never see you. There's a wall between A.T. Mathis and you because that information is private. It's kept with your documents. Now, people falsely assume that this type of structure here can carry over into Oregon and protect you when you go to own that property in Oregon. It will not. Because as we've already agreed, if you take this property or this LLC and you come into Oregon, you want to own this property, it has to be registered there. When you register that LLC in Oregon, you all have to list who is the current manager of the property or the LLC. And that is you. So you've just blown your anonymity. It's gone. Now, could you go back and ask Mr. Mathis to step back on for filing? You could. But as soon as he resigned his position, Oregon will require that you put your name up there right away, who the new manager is. So this form of protection only works in Nevada, Wyoming, Delaware, states that allow for this type of changing of the managers without having to update the Secretary of State. So anonymity planning to keep your information private doesn't work if all you focus on is using a Wyoming or Nevada company to own it. It would work, of course, if you fell into the Florida trap where you just kept this in Nevada or Wyoming and owned property in Oregon and never registered it here. That'd work for you until you need to bring an action to evict a tenant or until you're sued, then you've got problems. So why not set it up the right way? Understand how these structures work, and you can obtain anonymity by structuring it as follows. Now, this is what I mean by do not let the genie out of the bottle. Because if you started with this structure here, your information is always going to be made public. So when we sit down with a new client, one of the things we ask them is, how important is anonymity to you? Would you like a structure where we set it up, no one will know that you own it, and you can create LLCs in all 50 states, and contrary to what you may be told by a local attorney, your information will not be disclosed? It's possible, and I know that for a fact because I've been doing it for 17 years. I've been helping people protect their assets through an anonymity shield by utilizing the laws of Nevada and Wyoming in a way which is uncommon for most practitioners, meaning they're not familiar with this strategy. And the way it works is as follows. You do not start with this Oregon LLC because once that information's there, it's there. So what we have to start with is an anonymity protected entity. So we start, let's say, with a Wyoming LLC right here. So there's your Wyoming LLC, and again, we're going to go back and we're going to use the nominee manager guy, and you're going to be right here. And of course, you're the owner of this company. And so he resigns, and then you're listed as the new manager. That does not get disclosed anywhere. So this entity forms the basis of our structure. Oftentimes we call this a holding LLC because it's going to be set up to hold real estate and hold other business interests. That's all it's going to hold. It's never going to hold real estate. It could hold cash. Your savings could be inside of there. If you recall, in the flipping section, I discussed ways in which you can protect your own real estate by filing a first deed of trust against it, loaning money to the flipping entity. Well, that money would come from this LLC right here. This LLC can have many different hats. It can do many different things for you. One, it can be your bank. Two, it can be the holding of your various business interests where it provides anonymity. And that works as follows. Once this is set up, then I will create my Oregon LLC to own that piece of property that we discussed. So here's that Oregon LLC right there. Now, when this LLC is created, we have a choice. We can set it up as a manager-managed LLC or a member-managed LLC. If it's a manager-managed LLC, then you must list the manager with the Secretary of State. And if that's you, your information is now tied to this entity, so everyone knows that you have it. If it's a member-managed LLC, then you have to list the member with the Secretary of State. And if that's you, well, then you're again tied to this entity. But how about if we make the member this Wyoming LLC where you're not tied to it from a public record standpoint? From a public record standpoint, everyone assumes that this A.T. Mathis guy who's listed there is somehow associated with it, not you. I like to work from that perspective. This is how you build your anonymity protected structure. You start with this Wyoming LLC. Then when you file your Oregon LLC, you file it as a member-managed LLC. So it points down to this Wyoming LLC. So you list the Wyoming LLC's name on the Secretary of State filing for the Oregon LLC. So here's what would occur. If there was someone out there, they wanted to look at this LLC right here, and they want to say, who's associated with this LLC? It's going to point them to this entity here. And when they look at this entity, it will point them to this guy right here. It will not disclose any of these people over on this side of the line, which is you. So you maintain an anonymity shield in this manner. Now, something to keep in mind if you went down this road, the mistake that I've seen people make before where they set this up, this entity here in Oregon needs to have a registered agent. Every entity, when it's registered with the Secretary of State, is required to have a registered agent for service of process. Now, if you did everything I just showed you, but then for the registered agent, you wanted to list yourself, well, you can see how that one aspect, that one move, will blow your whole anonymity shield, because all they have to do then is look at the registered agent and say, wait, Joe is the registered agent. I can see what all this other stuff, but what is Joe doing as a registered agent for an entity? I know he's not a commercial registered agent, so he's not serving in this capacity for other people, so it must be his entity. So that's a mistake people make. That's why you always want to use a commercial registered agent here. When we set up the LLCs, we provide that to our clients so you have this complete overall shield. Now, as you go forth and you begin to create other LLCs, you would create them as follows. So if, let's say I decided to buy a property in Washington, I'd create a Washington LLC here to own this property. And again, everything points back to this Wyoming LLC. Let's say I bought a property then in Texas. It'd be a Texas LLC right here. And everything points back down to here. So no one knows who is associated with these entities because this hides the information. Now, other thing to note, when these entities are filed, they have only one member. all right? And that one member is your Wyoming LLC. Because they have only one member, you're able then to treat these as disregarded entities from a federal tax standpoint. That means that neither this entity, or this entity will have to file a federal tax return. And depending how you elect to treat this one, if your income is over a certain amount, maybe it's going to be an S corp. That's going to require taxation, a tax return, 1120S. If you want to treat it as a partnership because you're concerned about having too many properties on your Schedule E page 1, and you'd rather have the income show up on Schedule E page 2 because you're concerned about audit risk, then you would treat it as a partnership. But that would require that you have one other partner involved with you in your business in order to do that. Or if you don't want to file a return for this entity, you want everything to flow down on your 1040 Schedule E page 1, instead of doing either one of those, file it as a disregarded entity. So it doesn't have to file a tax return. So you can have literally 4 limited liability companies set up for you, and you have to file one return. I can always tell when somebody is set up or working with a CPA to create their structures, because I'll look at their LLCs and I'll find they have 4 LLCs and they're all filing tax returns. I think to myself, did that CPA set that up intentionally so he can get all those returns? Because you could set it up this way and eliminate them all, or at least reduce it down to 1. Depends on your situation on how you go about it. Now, what you'll see here is you're watching me create LLCs, 1 property per LLC. Now, this is a sound strategy from an asset protection standpoint, because if something were to happen in Texas, then this is the LLC that we lose. All right, that's the only thing that that I've put at risk. I've kept my Washington LLC separate and my Oregon LLC is separate. That makes sense, because this property's in Washington, this property's in Oregon, that property's in Texas. That's why we set up 3 LLCs. But what happens if you're buying, say, 3 properties in Washington? Do you still continue to set up Washington LLCs, or do you bury all 3 properties into 1 limited liability company? Well, that depends on your risk tolerance. I used to teach people for a long time to group properties. I would say put no more than 4 properties or 4 doors, 4 doors or 250K in equity in any given LLC. Good rule of thumb. And then one day I was approached while I was teaching a class. Somebody raised their hand and said, "Clint, how do you structure yourself? Do you follow this approach that you're telling us?" And I had to pause, and they caught me. And I said, "No, I do not. I use 1 property per LLC." And then a few students asked me, they said, "Then why are you teaching us a strategy that you yourself do not subscribe to?" And I had to think about it. And really, I was using my own biases, thinking that this is what people wanted, that they would look at this and say, this is overkill to adopt my strategy, that maybe I'm just scared of the boogeyman and it's not going to happen. And then 1 lawsuit wouldn't wipe me out. But truth be told, it does concern me. I don't want to risk anything any more than I have to. Remember, when you eliminate risk, you're able to take on more risk in a measured fashion. So when I put my structure together, I prefer to use 1 LLC per property, like this. So in Washington, I would have 3 limited liability companies. Now, the cost to maintain these LLCs is your registered agent fee, your filing fee. So it's a couple $100 a year to maintain them. And if you're wondering about tax returns, remember, I've already showed you that when you set up these LLCs, if you set them up properly as disregarded entities, you don't even have to file a tax return. So you can then separate them out. And so for most clients now, when I'm sitting down with them, my first go-to is telling them, hey, if you've got 3 properties in Washington, you got equity, you want to protect that stuff, you need to create 3 Washington LLCs. Hold 1 property per limited liability company. So if anything happens, then the only thing you stand to lose is that 1 property, and the other ones remain protected. Because there's nothing an attorney would like better than to go after an LLC that has a lot of assets in it. Because the more assets you have at risk, the more they know you stand to lose. And the more that you stand to lose, the more likelihood it is that you're going to give them a juicy settlement. So keep that in mind when it comes to structuring. 1 LLC per property. The LLC should be filed in the state where the property is located. And then all of those LLCs, if you're looking for an anonymity shield, should flow down to this Wyoming LLC to provide that. Now, one other aspect about this that I want to leave you with. It has to do with asset protection. If you recall when we talked about the form of entity you should use for holding rental real estate long term, I said it was the LLC, and you see me doing that here. And I briefly touched on both inside protection and outside protection. I talked about the charging order. Well, this particular structure here satisfies the problem of having an LLC that is set up in a state that does not offer charging order protections. Let's start with California, and I'm just going to leave it there as well. If I set up a California LLC here, and I'm sued as an individual, they can then take my LLC interest from me, and it becomes their LLC. That is the creditors who I'm referring to. So this is a problem. I do not want to own a California LLC personally because a creditor could take that from me. I only have one form of protection in California. So by taking that California LLC, and rather than me holding it as an individual, I stick it into this Wyoming LLC, I've now, through the use of the Wyoming LLC, provided charging order protections for my California LLC. And the way it works is as follows. You're down here, and we have on this board 5 limited liability companies. But if I were to bring you into deposition, I asked you how many LLCs you own, you're not going to tell somebody 5 because you don't own 5. How many do you own? You own 1. This is the only LLC that you own. Now this LLC owns these 4 LLCs, so you don't own 5, you own 1. So I get a judgment against you. And then when it comes to putting the charging order on your interest, I only have one option, and that is to charge the LLC that you own. And it so happens to be that the only LLC that you own is this LLC right here, and it's a Wyoming LLC. And in Wyoming or Nevada, if a creditor comes after you, their only remedy is a charging order. So as you recall, with a charging order, they only get whatever you take out of the LLC. I kind of left that hanging on the last segment when I talked about the appropriate structure for rental real estate. I didn't go into this. And you might have been left thinking, well, Clint, if you pull money out of the LLC and it has to go to your creditor, what good is a charging order? Well, I think the answer lied in what I just said to you, that when you pull money out, okay, because you're in charge of this entity. And are you really going to pull money out if you know that it has to go to a creditor? I think not. You're going to keep your money in here. You're not going to take a distribution so the creditor doesn't get paid. You can still continue to move money all around like this, never going to your creditor because nothing's coming out to you. Now, whenever I share this example with people and show them the power of using an entity in Wyoming or Nevada, they oftentimes shoot right back at me and say, Clint, that's all fine and dandy. I understand what you're telling me, but I got to eat. How am I going to get money out of my entity if there's a creditor down here and I can't distribute money to myself? Well, the answer is simple. You have other options. There are other outlets here. They may not be obvious to you on the board, but they're there. They're somewhat hidden. Remember, you're in control of this entity. If this entity has money and you want it, you don't have to take a distribution. How about take out a loan? You can loan yourself money. That's not subject to a charging order. There's a way to get money out. Real simple. Put together a promissory note, loan agreement, boom, there you go. You got your money. How about this? Create a management corporation up here. A management corp that manages all of these LLCs. And instead of taking money out as a distribution, you pay the company to manage your property. It's a great way to get money off of rental real estate is to create a management corporation. With that management corporation, you can pay yourself a salary, contribute to a pension plan, reduce your taxable income, pay for all your expenses as you travel around looking at properties throughout the country. Maybe you attend educational seminars to learn how to invest in different strategies or different areas of the market. Those all become expenses to this management company that you can write off. There's plenty of ways when you're creative to pull money out of your structure where you don't have to take a distribution. And it's for this very reason why, when people create structures that utilize Nevada or Wyoming, I can tell you from over 17 years of experience, if they get sued, they don't have to turn anything over. And in fact, what occurs is creditors come up and they see this structure. Once it's displayed to them, they turn around and walk the other way. I can think of 3 clients just off the top of my head that had multi-million-dollar judgments against them. And the creditors chose to let the client walk because they looked at their structure and they realized there's no collecting with that type of situation in play. So this is how we create structures for buy and hold, how many LLCs that you would need, and how you should hold them if you want an anonymity shield.